Hello and welcome back to the Dividend Wave. Today we will be discussing what we perceive are yield traps in the oil sector. First we discuss the macro view of the oil industry, and then we focus on three of the oil majors, ExxonMobil, Chevron, and BP. So what is a yield trap? We can define this as a high dividend yield that attracts investors to buy a stock for an attractive dividend. But if this dividend is not sustainable, the company may end up cutting or suspending the very dividend that was the goal of the original investment, making it a trap. There are usually warning signs. One is a decreasing earnings trend. So this means if the company is earning less and less each year, at a certain point in time, it will no longer be able to afford the dividends it pays out. The other one is the payout ratio. If it's high or in extreme cases above 100%, it means that the company will be paying out fully the earnings into dividends, or even worse, taking debt to service the dividend. The other one is if a company is operating in a declining industry and or market, if it cannot take share from competitors or decrease its margins or end up reinventing itself, it will end up cutting the dividend. Here, to illustrate these points, we have the yield chart for GE, General Electric, that was once in the 2000s the biggest company in the world by market cap. And in 2009, it was yielding 18%, but it ended up cutting the dividend. And it did so the same in 2017 and 2019. As we can see from this chart, in 2009, before the cut of the dividend, the earnings had been decreasing. And if the company had paid the same dividend that it had paid in 2008, it would have gone above 100% payout ratio. And we see the same issues here in 2017 and 2019. Basically, the company has negative earnings, so it's making a loss and it cannot sustain the dividend level. And we see a little bit the same with the cuts in the oil industry. We see that companies like Occidental Petroleum, Shell, and Norwegian Equinor have all announced dividend cuts over the last 2 months. So we start to witness some weakness in demand. After 10 years of incremental oil demand, we start to see it plateau at around 100 million barrels of oil a day, according to this graph from Statista. And where we see the sector with the most consumption is actually transportation. That takes around 70% of all oil in the US, and the figure is slightly lower elsewhere. So this sector is quite important to the overall oil consumption. And where we start to see some pressure is on the regulatory front. So some countries like Britain plans to ban new petrol, hybrid, and diesel cars from 2035. Other countries like Norway are planning it even earlier in 2025. And on the other side is the economic pressure, where we start to see two major disruptions appearing. One is electric vehicles, so EVs. And here we have the example of Tesla that is definitely becoming a household name. And also another one is transport as a service, or TaaS. To illustrate what the impact may be on the overall demand for oil, I'll give you a small clip from Tony Seba, author and entrepreneur that has discussed the issue at length.
Implications for the oil industry. Well, this is what I predicted in 2017 and what I predicted also in 2014. Oil demand is going to peak at about 100 million barrels per day 2020, this year. And it's going to drop to 70 million barrels per day by 2030.
So we really recommend that you watch Tony Seba's presentation to understand the arguments that he makes on these disruptions. We will drop it in the show notes. So he makes the case for 70 million barrels of oil per day. And actually, what he mentions is not too far off from a study that McKinsey did, where they look at the demand in the several sectors of oil consumption, from road transport to chemicals to aviation. And they take their reference case, which is a flat 105 to 110 million of barrels of oil per day, and then factor in what accelerated transitions we may expect. And they come with a figure that maybe a few years later, but maybe not too far off from the 70 million that Tony Seba calls for. So what if we could test this lower demand theory and what it means for pricing? Actually, it seems that we just did. According to the US Energy Information Administration, the global oil demand dropped to around 80 million barrels of oil at the end of Q1, beginning of Q2. And for pricing, it meant that the Brent went as low as $20, which validates the case of Tony Seba. And the WTI famously turned negative in the futures contract. On the supply side, obviously, there are a lot of elements to consider, but I think three are worth noting. The US has gone from being number 3 in 2008 to being a distant leader as of 2018. The other one is that the OPEC currently only commands about a third of all oil production. So with this picture, we have reason to believe that if there were a dip in demand, that the prices would stay sustainably down. So today's three companies, we have some very interesting current yields with Chevron almost at 6%, ExxonMobil above 8%, and BP in the range of 11.5%. So the downside to these three companies is that the 4-year payout ratio has been above 100%. And as we've seen before, this is a potential sign that a dividend cut or suspension may be about to happen. This is a direct consequence of the price of oil over the last 4 years, which has been lower than the years before and has caused this imbalance where the companies have had to pay more in dividends than what they have earned. So from a Chevron investors presentation, we have some very interesting information here. So basically what is being said is that for a dividend break-even, Chevron needs a Brent oil price at about $55 per barrel. And their competitors are on a much higher level compared to them. And this seems to be backed up by some analyst estimations. Now, this leads us to almost a binary question, which is, this dividend to be sustainable, will oil be above 55 for the foreseeable future? So we can put all this discussion of the oil majors and their dividend sustainability on this equation here of oil at 55. In our opinion, this will not happen. The oil is set for a secular downtrend, and we believe that this will not be the case. So we believe that oil is actually a yield trap at the moment. So we hope you have enjoyed today's show. Please drop us a comment, give us a like, and subscribe. Remember, this is for your entertainment and information, and it is not financial advice. Thank you for watching, and we will see you soon.